In this special edition of On Point by Oak Street Funding, we're diving into critical new updates from the SBA that could impact how you secure financing. What do these updates mean for your business, and what other financing options should you be aware of? I'm Matt Staninger, Market Research Analyst here at Oak Street Funding, and joining me to break it all down is Alex Weaver, Strategic Markets VP.
Thanks, Matt. First of all, why have the SBA made these changes?
In 2023, the SBA loosened many of their requirements to allow more business owners to access capital. However, this led to an increase in defaults, and the SBA lost money last year. This, coupled with recent layoffs, has forced the SBA to make significant changes. The SBA isn't going anywhere anytime soon, but it will look a bit different going forward.
So when do these changes go into effect, and what are some of the more significant changes?
The latest changes went into effect on June 1st, 2025. Today, we're going to break down the most critical ones, focusing on ownership and collateral requirements and key changes to loan limits and down payments. Let's start with the big one for anyone involved in buying or selling a business: ownership and personal guarantees. Previously, for business acquisition or succession deals, the exiting owner had a grace period, sometimes remaining involved for a period of time to ensure a smooth transition. This allowed for a more gradual handover and could even involve the seller holding a note. However, the new rules are much stricter. Now, in a complete change of ownership, the seller must exit the business immediately. Furthermore, sellers who are able to retain any ownership, which is also much stricter, must personally guarantee the buyer's loan for a minimum of 2 years after the loan disbursement. This means the seller's personal assets, their home, savings, their investments, are all directly tied to the buyer's loan even after they've sold most of their business. This impacts how deals are structured and adds a new layer of risk for sellers, which we'll discuss implications for. Next, let's talk about collateral and down payments, particularly for smaller loans. In the past, SBA loans under $500,000 often didn't require a personal down payment or additional personal collateral beyond the business assets themselves. This was a huge benefit for many small business owners. The landscape's now shifted back to how it was before 2023. That limit's been significantly lowered to $350,000. This means that any SBA loan of $350,000 or greater will now typically require a 10% down payment. This is a mandatory cash injection from the borrower. But it doesn't stop there. For these loans, lenders are also required to take personal assets as collateral. This is a critical distinction. It means that if the business loan defaults, the lender isn't limited to just seizing the business assets. They can now pursue the borrower's personal assets, including their home, personal savings, or other properties. This significantly increases the personal risk for borrowers seeking these loans. With this increased red tape for borrowers seeking financing, Alex, what options are available for borrowers looking for a lending atmosphere that's more flexible for M&A?
Yeah, so M&A is key for business owners looking to grow their business, and there are conventional lending options available that have fewer restrictions than the SBA. A critical element for truly successful, smooth business transition, particularly in the acquisition or succession deal, is the ability for the seller to stay on and remain involved in the business for a period of time post-sale. This ensures continuity, knowledge transfer, and helps maintain client relationships. Often, conventional lenders can structure these deals with vital tools like a seller's note, where a portion of the purchase price is financed by the seller, or an earnout, where additional payouts are tied to future performance. This kind of flexibility is incredibly valuable, especially for business owners planning to complete multiple acquisitions as a part of a more aggressive growth strategy. It allows for creative structuring that isn't possible under the new SBA rules.
Okay, what about personal collateral and down payment requirements? How do conventional lenders typically approach those?
Conventional lenders typically don't require a down payment from the borrower. In fact, here at Oak Street Funding, we often structure deals in a way that doesn't require a down payment from the borrower. So for borrowers looking to invest in their business with a working capital loan of, say, $400,000, typically there are no requirements for the borrower to contribute any money up front to that project. This frees up your liquidity and protects your personal savings. Additionally, there may be other structures such as a line of credit that can offer different levels of flexibility that can help meet borrowers' needs. Conventional business loans typically rely solely on the assets of the business's collateral. There are no spousal guarantee requirements or liens taken on personal property. Furthermore, conventional lenders can offer more customization and flexibility because they operate outside the limitations of the SBA. So there may be a need for a debt restructure from a previous loan needed, and there is also a need for a technology upgrade. This can be structured together in terms that make sense for the borrower's need.
So increased flexibility with conventional loans. What makes Oak Street Funding different from other conventional lenders?
First, we're not a traditional bank. We specialize specifically in the cash flow industries like CPAs, insurance agencies, and registered investment advisors. This deep industry knowledge means we understand the unique nuances of your business, your revenue streams, your operational cycles, even how your practice is valued more than a traditional bank. This isn't just about offering a loan, it's about building a long-term relationship. Secondly, our lending model is centered on cash flow, not tangible assets. While many traditional banks fixate on things like real estate as primary collateral, we're focused on your business's recurring revenue. This is the crucial difference, allows us to be more flexible, and it means that we can often structure deals without requiring a significant upfront down payment from the borrower, and critically, without needing personal collateral like a home or other property tied to the loan. Finally, as a direct lender, we're not bound by the rigid one-size-fits-all rules that limit many larger institutions or even government-backed programs. This allows us to offer truly customized financial solutions, and all our processes are in-house, and as a portfolio lender, your loan will never be sold.
Thank you for that information, Alex. To wrap things up, while the SBA serves a vital role, their new rules introduce new complexities and risks for business owners. But here's the good news. Conventional lending offers a flexible, often less restrictive path forward. For acquisitions, working capital, succession, or partner buy-ins, conventional lenders like Oak Street Funding can provide tailored solutions that prioritize your business's unique needs.
Visit us at oakstreetfunding.com or call us directly at 866-625-3863 to start a conversation. Let us help you navigate the evolving lending environment and secure the capital you need to thrive. Thanks for joining us on Point.